Good evening. Thank you guys for joining us. We're going to wait a couple more minutes, see if we got some more people still trying to sign on. Just a couple housekeeping things. On the right side of your screen, there's a handouts tab, and the slides for both of our presentations are there. There's also a chat box there. Any questions you have, please put them in the chat. Everyone is automatically muted on this, and we'll be watching that as we go. So if you have anything, just jump in and ask a question. So tonight, I'm going to talk a little bit about LRP, a little bit about LGM, and then Randy's going to talk about the cattle markets.
The funner of the commodities right now.
Well, yeah, the grains are just depressing, so. You want to get this started?
Might as well.
Okay. Like I said, chat window's on the right. Have any questions, just jump in and start typing them in there. We'll keep an eye on that. When Ryan and I were talking about this, I kind of had lost track of where we sit premium-wise. This chart shows farmer paid premium from the 2023 crop year. And the green is LRP, so that's way outpacing everything else. Swine actually is more premium than feeder cattle and then the fed cattle. Unborn is part of feeders. I just threw that out there separately. We were just curious where that's at. I'm actually surprised that's not higher. The tan one is the dairy revenue protection, and actually the crop there is milk. We're not going to talk about that. And then livestock gross margin. It's been around for a while. Never has really caught on as much as LRP. And there again, the swine lead that, followed by dairy cattle and then cattle. So we'll talk about both of those a little bit. LRP, you may or may not know about this. LRP is just protecting against declining price. There's no minimum head when purchasing. This is subsidized like other crop insurance products. LRP is different because you can complete an application at any time, but endorsements are submitted later, and that's what binds the coverage. Basically, we cover feeder cattle and fed cattle. For the feeder cattle, length of insurance coverage is available in all these weeks, and I'll show you a quote later. Coverage is available mainly what we see: steers, heifers, and then unborn. If you do own the cows, you can insure those calves before they're born, up to a weight of 599 pounds. So on the feeder cattle side, that is everything up to 1,000 pounds. On the fed side, again, same number of weeks. Coverage for steers and heifers is just thrown together. And here we now go up to 1,600 pounds on the fed side. The livestock policies are different than other crop insurance policies. On the LRP side, we get new quotes every day the markets are open. Usually we see them at 3:30. They're always going to be up by 4:30. Those quotes are only good until 8:25 a.m. the next morning. After that, the program shuts down. We have to wait for the next set of quotes to come out. And it's just a process that happens every day the markets are open. Big change they did this year. We used to have until 9 a.m. to book endorsements. RMA finally started looking at numbers, and pretty much everyone was waiting until after the markets opened at 8:30 to book LRP. So they took that away from us. So now by 8:25 a.m., basically the paperwork has to be signed, the endorsement has to be entered in the system, and I have to actually upload the documents, all by 8:25. This kind of means that we're going to be doing a lot more LRP in the evening now. If we could do it right at 8, it gets too much later after that, and it just gets hard to get all that stuff done before 8:25. So just be aware of that. This is just a quote example of LRP. I don't know how well you can see that. This is yesterday's quote for 900-pound steers. And what it's just showing here is we've got these different weeks. Here's the 21 weeks. I think that's the 28 weeks. And you have all these different choices of coverage, depending on how high a coverage price you want to lock in. This is the same quote. It's just showing the highest price for every week. So you can see for the steers there, 13 weeks would take us out to May. He could go all the way out to 47 weeks. That would take you up to the end of December. And again, these come out every day. We do have a system that automates quotes to everyone every day. So if you would like to just see quotes every day, let us know. If you're getting quotes and you want some different weights, let us know that, and we can add you to the list, send those out every day. So this is an example of one we actually did. This is a real customer. He booked way back on March 13th of 2023. He said he was going to have 80 head unborn calves that were going to hit around 600 pounds early December. So when he booked that way back in March, he could insure the unborn calves for $1,374 a head at a cost of just under $40 a head. And at that point in time, back in March, in red there, the coverage price was $229.34. Now, this one did expire in December. And again, all we have to do on LRP is you just tell us what type of cattle, what the weight's going to be by the end date, and when you're going to sell them or market them. So this one, coverage price was $229 in March. By December, it came into $226.86. And then how you get paid on that is just your number of head times that target weight times the difference in prices. So in this case, he got $1,188. Now, just like all other crop insurance, the actual ending value is not what you specifically receive yourself. It is a number that RMA comes up with, and I'll show you how they get those. The ending values for feeder cattle are based on the Chicago Board of Trade cash settled commodity index prices. On the Fed side, they're looking at the AMS slaughter weight numbers. So again, you're just going to tell us, I'm going to have 750-pound steers that I want to market on this date, and we book that. And then we wait until it expires. After the end date, if there's no loss, you'll get a form from the company showing what the prices were, that you had no loss. You are not billed until the next month. If there is a loss, you'll be sent an ending value form. You need to attest to those statements. And the new thing now is you also have to provide documentation. We did not used to have to do that. So basically, you're just going to certify that, yes, you own the livestock, whether you sold them more than 60 days before the end date. In our example, it was December 11th. And were they sold by the end date? And that just determines what documentation we need to provide. And that 60 days is important there. You can sell up to 60 days before it expires. If you sell earlier than that, unless there was some drought-related reason or something, you would not have coverage. You can hold them later. There is no penalty for holding them longer. So if you sold these cattle by the end date, like I said, in our example, that was December 11th, they just want receipts showing that, yeah, you really did sell the 80 head and they really did hit, close to that 599 pounds. If you're off by the weight or if you're off by the number, your claim will be reduced. Your premium will not be reduced. So you want to probably aim just a little bit on the light side there. If the livestock were not sold, we just need some kind of documentation that you own the cattle. Purchase agreements, statements from your bank. We've had the best luck with statements from the vet. Either receipts showing the vet was out there vaccinating them, or we've even just taken like a written statement from a vet on their letterhead, and that's worked. So they've been really good to work with us on all those. So a couple of examples. In this example, you booked an endorsement for 100 head. You said they were going to hit 700 pounds. When you sold them, you only had 95 head, but they were a little bit over the 700 pounds. In this case, we would knock your coverage down to 95 head. Again, would not reduce your premium. And we just go with it from there. And again, I should say, you do not have to insure all of your cattle. You can insure them in different chunks at different time periods. You can insure, half of them. Doesn't matter. The other example would be you've got your 100 head, insured them at 700 pound target weight, but when you sold them, you had the 100 head, they were only at 525 pounds. And again, if there was a drought or something going on where you had to just sell them earlier, then you wouldn't be, your coverage won't be reduced. If you don't have any kind of circumstance like that, they're going to knock your coverage down. And they basically do all their math, which I won't go through. At the end of it, you insured 100, you're only going to get paid for 89 head in this specific example. The ones we've run into, people are off just a little bit. It hasn't made a lot of difference to their claim amount. Okay, so that was LRP. And that's the one I think we're most familiar with. We've booked a lot of LRP these last few years. LGM isn't as well known. Randy and I were talking earlier, this used to be a more complicated program, and I think that turned people off. And then over the years, they've simplified it, but I think, it just doesn't get the press that the LRP does. So LGM is livestock gross margin. It's protecting against loss of gross margin, available for cattle, dairy, and swine. Just like LRP, you can do an application anytime. Just like LRP, no coverage attaches until you actually do that endorsement. LRP or LGM is different than LRP. LGM quotes only come out on Thursdays. If Thursday's a holiday, there'll be no sales at all for the week. And just like LRP, those quotes will come out Thursday afternoon. We have until 8:25 a.m. the next morning to book that endorsement. With the LGM, there's either calf finishing or yearling finishing. So like I said, with the LRP, it was what kind of cattle are you going to have? What's the weight when you sell them? And what date will you sell them? On the LGM side, it's going to be, are they calf finishing or yearling finishing? And then again, how many head and when will they be sold? So on the LGM side, again, they're looking at the price, but they're also looking at the cost of feed in this one. LGM has a deductible anywhere from $0 to $150 a head in increments of $10. And the catch on this one is you have to market at least 75% of the cattle you request insurance on to receive the full indemnity. And this is a bit more liberal than the LRP is. So again, just like the rest of crop insurance, we're going to have these expected prices. Again, expected corn prices, feeder cattle prices, all coming off Chicago Board of Trade futures contracts. And again, same thing as LRP. At the end of the endorsement, RMA is going to calculate a price. For the cattle, it's going to calculate a price for corn again. There's a quote example. On LRP, they talk about the insurance period. And in LGM, I'm having trouble with that tonight. LGM, we talk about the insurance period, and that's what's in that top right corner. For the quotes we're running right now for LGM, the insurance period runs March until January. So there's always a lag month. We get to March, or March is our lag month. So you can start insuring them with sale dates in April through January. And again, you just need to tell us, yep, I'm going to sell 100 in May, and I'll sell 100 again in November, and I'll sell 200 in January. And we can just put that all in their bucket. The top part of the quote there is a 0 deductible. The bottom is the 150. Again, those are the two extremes. We can go a lot of choices in between that. Question that always comes up, can you have both an LGM and an LRP policy? Yes, in general, but you obviously cannot insure the same covered livestock on both at the same time. You also cannot insure the same class with the same end month. So an example is you have 1,000 head of cattle. You put 600 head on an LRP with an end date in October. You cannot then take out an LGM policy with an end date in October as well. Just a couple of slides. This is brand new. WeCap Revenue Protection. This is a brand new pilot program. We just had the sales closing January 31st. This was only available in Colorado, Nebraska, South Dakota, and Texas this year. And this is treating cattle like a corn or a soybean policy. We're going to have calves reported instead of acres. We actually are going to have an APH database with an approved yield that is based on the weaning weight. If you don't have good documentation for past years, we're going to have T yields like anything else. We'll have a projected price, a harvest price. You pick a coverage level just like you would for corn or soybeans. And it does that same kind of math. The nice thing about this one is now we finally can cover something besides price. Now, if a snowstorm comes through in the spring and it kills some calves, that will be covered. Other things go on, they don't meet the weight that historically they make normally, you'll be covered for that. So it covers weather conditions, just like the rest of crop insurance. What it does not cover are things like aborted pregnancies, stillborn calves, calves that die before you get them listed. The downside of this program is there's a lot of paperwork in this. Adjusters have to come out at the beginning and make sure you have the facilities to do the number you're talking about insuring. You have to report calves as they're being born. You have to let the company know so many hours before you wean them. There's just a lot of paperwork in this one, a lot of moving parts. I'm really glad North Dakota didn't get on the first year of this. I'd like South Dakota to be the guinea pig. This could be a good product. I think they got some kinks to work out that first year, so hopefully they can get that rolling, and hopefully we can see that expanding to North Dakota in one of the next few years. That is all I have, unless you have questions, and otherwise we'll get Randy rolling on his. Oops, there we go.
Oh, yeah, that's better. Okay, since no questions yet, I'll just jump right in and start talking a little bit about on the livestock side of things. And like I said earlier, I mean, it's been the better market. We've been seeing a little bit better performance since the December sell-off happened. And it's kind of nice to see the market be able to bounce back up again. But making comments here today, it looks like right now the cattle market might be getting a little bit tired. We've pushed pretty good. We've got some of the reports out of the way, and there might get to be a little bit of pressure that comes into the market. But first off, I want to look at it. Well, I guess the first thing that I have to do is put the disclaimer up, let everybody know that past performance is not indicative of future results, and our NFA disclaimer, I guess, to make us legal with the CFTC and NFA. So, but I'm going to talk a little bit on the cattle side of things. My daughter wants to have Highland cattle, so I compromised and I use a picture of a Highland cattle for the presentation. So hopefully that helps a little bit to stave off the need to buy one right away. But looking at the numbers that we've seen here, though, as far as the cattle are concerned, you look at what the cattle and feed report that came out at the middle of January was about as close to being as expected as you could get. You're looking at the numbers where on feed came in at 102. Pretty close to the average trade estimate. Placements came in at 95, almost 96%, about where we were expecting. And then marketings came in for December at 99. I'm pretty close to what was expected. So the last couple of reports, we've actually seen the placements a little bit higher than anticipated. Marketings were a little bit lower. And so this one came out pretty close to expectations. When you look at it as far as January 1 on feed numbers going back through history, this is all of the January 1st number of cattle on feed all the way back to 96. And you can see it wasn't one of the highest, but it was quite a bit higher than last year. Little less than what we saw the previous or 4 or 5 years ago. So we have quite a few head of cattle that are in our feedlots when you look at it comparable to the last few years. But when you look at it for this year, we put us up there in the top 4. The trouble with it is it's not just U.S. cattle that are in the feedlots. A lot of them are coming in from Mexico and from Canada, and we're seeing we did see a pretty large increase of imports from those two regions through the summer and through the early fall, and that's where a majority of the cattle came in that went into the feedlots and showed up as the on-feed numbers. I believe increases from Mexico for I believe it was the July, August, September timeframe were up like 36%, and we were up about 25, 26% for Canada. So we did see a pretty big increase, and a lot of that is due to dry conditions and them not having the place to feed them and them coming into the U.S. and going into our feedlots. When you look at the number of cattle placed for December, we actually were at an 8-year low. For U.S. cattle going into the feedlot. So we actually were looking at some pretty low numbers. And you can see by the time where we finished off the year, we were the second lowest, only to what we saw in, I believe it was 2015. Looking at it as far as marketings, for marketings, we were actually one of the lowest marketings since way back to 2015. Part of that was, for the month of December, we had some storms come in that slowed down some movement of cattle, and that caused a little bit of trouble. We also had a slowdown in chain speeds and packers. So because of the prices were high, they started to slow down their kills, cut out Saturday kills, and that kind of started to back up feedlots a little bit and caused a little bit of trouble with marketing. So that was part of the reason that we saw. And again, you can see it was the second lowest that we had in since 2015. So that's the on feed side of things. Now the big report that came out was the one that came out here in January 31st, I believe it was, and that was the cattle inventory report. And this is the one that everybody was looking forward to. And most were saying it wasn't a matter of if we were going to see a smaller cattle herd, it was how much smaller was the cattle herd going to be. And when you look at it, total cows and calves, this takes in dairy, this takes in calves, it takes in beef cows. It came in about 2% less than the previous year. So again, we're continuing to see that downward cycle where we've seen 5 years in a row where we've seen the cattle numbers decrease. When you look at it for all cattle and calves, it's the lowest number of cattle since, I believe, 1951. And again, like I said, the fifth year in a row that we're seeing decreases in the cattle numbers. And when you look at the states, everyone that's in red saw decreasing cattle numbers from 23 to 24. Only a few states saw unchanged numbers and a little bit of an increase, mainly because of they had a little bit more moisture and a little bit more, their pastures had recovered a little bit, so they were able to rebuild some herds in some of those areas. When you look at it for just the cow side of the equation, the beef cows are over on the left side, I guess it would be. And you can see where we hit our bottom in 2014. They had a nice recovery. But again, then in the last 5 years, we've been seeing a pretty good drop. For beef cows, we're at the lowest number of beef cows since 1961. And it was down roughly about 2.5% from the previous year. Milk cows weren't down as much. But when you look at all cows and calves again, like we mentioned, it's about 2%. So again, pretty low numbers when you look at it. And this helps to kind of solidify that the cattle markets have the potential to stay strong over the next couple of years because of the slow recovery that we can have to try to rebuild our herds. When you look at it as far as the top 10 states, as far as cattle are concerned, this gets to be kind of interesting, this little schematic, because the top 10 states, Texas is by far dwarfs everybody else when it comes to cattle. They've got just about twice as many, or more than twice as many, as the next closest one in Oklahoma. And then we have some that are fairly close to each other. North Dakota falls in line as number 10. So that's that was a surprise. I didn't think we'd be that high up on the list in cows. But when you look at these top 10, just for the change from 23 to 24, we saw a decrease in herd size by about 716,000 for the whole U.S. For this top 10 was 569. So a majority of the numbers from these top 10. But when you look at it for the 5-year average, or the 5 years that we've seen from 2019 to 2014, these 10 states accounted for 2.3 million less cattle, and the U.S. in total dropped about 3.5 million head of cattle. So in 5 years, we've pulled down the cattle herd tremendously over the last, in a very short period of time. When you look at it as far as numbers, more of a schematic, you can see that Texas is by far, like I said, the leader as far as the cattle market is concerned, or cows are concerned. And you can see where the rest of the states kind of fall in line, with Oklahoma, Missouri, Nebraska coming up there. And you can see that just about every one of them has a stair-step approach, which means that, 22 was the largest numbers, 23 reduction, and 24 reduction. There's a few states like Minnesota that's kind of stabilized. I put them in just because of being our neighbor, and in Iowa as well, more feedlots and stuff. But look at Montana. Most of the states do see reduction taking place. Kentucky is the only one that probably stayed even with last year, and North Dakota fairly close as well. When you look at heifers, this is one of the important numbers to look at, because this is the one that's going to give us the idea if we're going to be seeing herd expansion. And we actually saw the beef cow replacements down by about 1% over compared to a year ago. But what's even more interesting is when you look at when the adjustment they made in the numbers from last year, because they actually cut the retention, or heifer retention, from 23 compared to 22. And that's a pretty interesting number. But again, this is the lowest number of heifers we've had since all the way back to 2004. So we're seeing a pretty good, well, we're not seeing herd expansion. There's no question about that. We're barely maintaining the herd, because you look at it as that you're culling out cows every year that, because of age, we're not bringing as many back into the breeding herd. So that's part of the adding to a little bit to the shrinking of the numbers. And pretty soon, we're going to age out our cows. So we're going to run into, as you move forward, it's going to get even worse, because we're going to be culling a lot more than what we're going to even have the opportunity to hold back. And here's what I mean by looking at, this is the heifers, the numbers that were retained in each state for 22, 23, and 24. The revision to the 23 number dropped down the retention in the US down to 4.9 million. It was 5.16, so about 230,000 less. So that actually means that we were looking at about a 10% less heifer retention in 23 compared to 22, which makes 24 is even a little bit smaller than the 1% that we did see. And again, it just leads to the importance of how fast or when we will be looking at rebuilding the herd at this point. As I mentioned, this shows over time what the heifer retention has been at, and you can see that the last 2 years have been the lowest. And you look at what the prices that you can get by selling the calves. It makes sense to be cost effective to be selling the heifers because of the price that you're getting for them, or putting them into the feedlot and finishing them, as opposed to holding back. We're looking at the second, third highest prices we've ever seen in our lifetime. So there is that draw to move them into the marketplace as butcher animals instead of retaining them on the breeding side. But again, like I said, that's going to start to compound the problem here fairly quick here, just because we're not going to be able to replace the aging herd fast enough. And when you look at the states that are looking at where the breeding herd or where the heifers are kept, you can see that actually Texas held back a little bit more. Just about every state held back a little bit more heifers in 24 than what we saw in 23, except for Kansas, because they were dry. They didn't have the ability to hold back heifers or retain heifers. So they actually moved more into the feedlot. Missouri, same situation. And we're looking at even Arkansas and Iowa. So didn't see as much there, but we did see a few more being held in some of the other states. So we did see some heifer retention, but overall, as far as the nation is concerned, it wasn't as much. And here's what was the biggest problem why we saw, or one of the leaders that we saw to the reason why we saw a big reduction as far as the cattle herd again this year. And that is that we had set up, the drought was set up in the major cattle regions of the U.S. You can see as of December, end of December of 22, a majority of the drought was sitting up right into the middle section of the U.S. Even into June, we were still looking at some pretty nasty drought conditions, especially South Dakota, Nebraska, Kansas, and into Oklahoma, and then across into Missouri. But right now, things have gotten a little bit better. This is as of January 2nd. We are actually seeing a lot less drought situation, especially when you look at Texas and Oklahoma. When you look at the drought monitor map that came out here now in January 3rd, we're seeing still a little bit of drought situation as far as New Mexico is concerned, but Texas, except for the little area, is pretty much out of it. Oklahoma, Kansas is sitting good. And then, of course, South Dakota and Nebraska. So right now, drought has been alleviated in most regions. We're starting to see or hear the talk of the possibility of trying to repopulate some of the pastures that have been left quiet or idle because of the more grass and a little bit more available to be able to run the cattle on pastures. But nobody has really stepped forward yet to do that. But there is starting to be talk, if we can get through this spring, all right, we might start to see some heifers start to go back and start to get retained in some regions. But when you look at the deep part of the moisture, the Palmer Drought Index, this shows more deep soil problems or moisture or drought. And you actually see that, some of the areas are actually on the moist side. The darker the green, the more moist it is. The lighter the color, though, that means there's a little bit more of a drought situation. You can see that North Dakota and Minnesota are a little bit into that region yet, but some of the South has started to come out of it. So that's kind of helping them to consider starting to rebuild some of the herd, or potentially starting to build herds back again. When you look at the calf crop, it wasn't the smallest one that we've ever had, but it's getting close down to where we saw in 2014. Calf crop coming in at about 24.7, down 2%. So that, again, is telling us that we've got less calves that are going to be available to go into the feedlot. We've got less calves that are going to be available for the breeding herd. So that we're going to continue to see that shrink as we move forward. Once we start to retain heifers, that is really going to start holding back as far as the fat cattle market is concerned. And that should then give the fat cattle side of things or the butcher side of things another year of opportunity to see some pretty good movement because of being some of the cattle being withheld and not going into the feedlots. When you look at production, U.S. has now overtaken Brazil. Brazil was one of the largest producers, or was the largest producer of beef. They've started to tear up some of their pastures, and they've kind of relinquished their crown as far as the largest beef producer. U.S. is right now, not by a lot, but we do have the crown. For our production, though, you can see that this is in a billion pounds. In 22, we produced the most at 28 billion. That's dropped down to about 20, just a little over or under 27 for 23. And then we're expecting in 24 to see another reduction as far as the tons of beef that we're going to be producing. But what's interesting, and I think this is the biggest wild card as far as the cattle markets are concerned, and that is where is consumption going to be. We also peaked in 2022 at about 59.1 pounds of beef per capita. That was the consumption per capita, largest that we've seen. And that was coming off of what we saw from the COVID years in 2020 when we dropped down to 57. Of course, the biggest trouble then was that most people weren't eating out in restaurants, and that really trimmed back the beef demand. Well, as we started to come out of lockdown, we started to see people return to restaurants and return to eating out, and that helped build it back up to 2022. Now we're seeing the economy or inflation that's kind of pulled it back in 23, dropping it down to 58.1 pounds of beef per capita. And then in 24, we're looking at it dropping back a little bit more to 56.5 pounds. So, and a lot of that is all being tied just more so to economics than anything else. I think the biggest thing to watch going forward as far as the direction of the cattle markets now are how is the economy going to respond? We did see in September when we were peaking out in the market that the consumer does have a threshold that they will spend. And we were kind of reaching that when we were hitting $300 box beef prices. The consumer started to push back, and that kind of started that snowball rolling downhill with the packers slowing down their kills. We started to see back up as far as the feedlots are concerned. We started to see weights go up. The market started to see a little retracement. And pretty soon we pretty much had given up most of the run that we had with the live cattle dropping $30 and feeder cattle dropping $60. So now we've slowly worked back to that. And I'll show some charts at the end that kind of give a little bit of idea of what it looks like. But with this recovery now, we do know that the consumer has a threshold of what they are willing to pay as far as the beef is concerned, and we're getting back up into those levels. So we'll see if this continues to hold, or if we can continue to keep the demand going domestically. The other big thing that we have to watch is exports. And in 23 or 22, we set record high exports for beef. China was buying aggressively. A lot of other countries were buying because they needed product. Again, a lot of countries were coming out of lockdown, coming out of COVID, and they were seeing a return to their economy and a lot of spending. And beef was one of the things that they wanted. So we started to export quite a bit of beef. We've seen, because of the prices, because of inflation, a little bit of a slowdown over the last couple of years. And again, right now we're estimating it to be about a what would that be? About 2.8, 2.9 million or billion pounds that are going to be exported, down quite a bit from what we were looking at just 2 years ago. Where most of it is going, or who's doing most of the exporting, right now, Brazil's doing a lot of the exporting. You can see where the US, we're coming in fairly close. Australia, these are our competitors. New Zealand has pulled back their exports a little bit. They've actually kind of, because of carbon sequestration and because of green wave, New Zealand is kind of slipping a little bit away from being a major player as far as the cattle markets or the beef markets are concerned. And you can see that over the last couple of years that their exports have kind of slowed down. But you can see where the US kind of stacks up. Australia is still quite large, and then Argentina, but Brazil is by far the larger exporter. And where does most of our beef exports go to the major markets right now? Japan and South Korea are our biggest buyers. You can see they've been consistently the biggest consumers, but everything has a little bit of a slant down to the right corner. You can see that everything is trailing off a little bit as far as exports are concerned, and a lot of that is due to the higher price. But look at what China did. China's the gold bar or the gold line, and they virtually were non-existent up until 2020, and then they started to buy quite a bit by 21, 22, mid 21 to they were buying quite a bit by the mid of 20 or towards the end of 23 or 22. They were pretty aggressive as far as our market was concerned, almost one of the largest buyers of beef from the US for a few months. Now they've kind of backed off a little bit as their economy is starting to struggle. They're kind of pushing back on buying beef from the US because of the cost as well. So that's something that we need. Kind of the theme here is that we have to be cost competitive, and right now with the prices up where they're at, we kind of lose a little bit of our share of at the table. But what's been interesting, I mean, one of the things, of course, if you're taking heifers out of the breeding herd, you're putting them into the feedlots. This is kind of a busy chart, but the red line shows the heifer percent of the steers and heifers that are going to slaughter. And right now, if you look way over here to the right in 22, we were looking at heifers being close to 40% of the slaughter numbers. When you look at it as far as the beef cow side of things, they were running at just a little bit over 11%. And that has increased dramatically from 2016. You can see how much more the beef cow percent has gone up because of a lot of cows going to town and the reduction in the herds. And this kind of shows the same thing as when you look at what the percentage of makeup of the steers and heifers in the fed cattle market side or the slaughter side. You can actually see the steers numbers have gone down to be about 60%, slowly started to lose their share of the feedlot space, and heifers have slowly started to see a pretty good increase. And even when you look at the 12-month average, so we're continuing to hold fairly steady at around that 40% of the animals being fed out in the feedlots are heifers, while 60% are coming in and being steers right now. Let's see. And part of the reason when you look at where the beef or where the cutout values have been at, we've started to see it kind of waffle a little bit again now recently. And we're just over 280, getting close to 300 again. That seems to be the level that we start running into a little bit of pushback when it comes to as far as the consumer is concerned. You can see we have gotten higher over the last couple of years, but it seems like every time we get up to those levels, we do start to see a little pushback and the markets start to give back some of their gains. I'm not surprised if we don't see that happen again now, where we start to see a little bit of a pushback from the consumer and looking for a little bit cheaper prices. When you look at the dressed weights, as I mentioned, as we went into the end of the year, we started to see weights, creep up a little bit. They dropped in December just because of the storms. We have seen a pretty good drop down now again after the first of the year. That's certainly helping as we're pulling, that's taking quite a bit of weight off. Just even if it is that 840 down to 833 in that area, that does make a big difference when you look at it as far as the number or the tonnage of meat that hits the market. And we've kind of seen the same thing as far as the steer side as well. We were hitting some pretty heavy weights. Actually, the highest that we've seen in years when we were at that up close to that 920. Now we've seen a pretty good drop. We're actually below the 920 level. That's helping a little bit as well. But it's likely we're going to continue to see those weights drop as I think packers are going to get to become a little more hungry and trying to buy cattle ahead and buying them a little more green. And here, when we start looking at the charts, I mean, this is the April live cattle chart that goes back a year, and you can see that we had a really nice run up in the markets. I mean, that's a beautiful uptrending chart. Stalled out a little bit, and then we started to see the markets crash. And I'm a believer in gaps get filled. And you kind of see where they kind of fall into play. Usually this gets to be a breakaway, then you get to see a measuring gap, and then you get to see an exhaustion. We kind of don't see them in this, but we dropped this market down $30 from where we peaked down to the bottom, and now we've recovered back and got in about a little $20 back, somewhere in that area. So we've recovered a pretty good share of it. I do think we've got a little room to move to be able to come up and maybe get to this 188, maybe up to the 190 area to close these two gaps that are sitting on the market yet. But I think that would be about what this market would have the ability to run to. We didn't break 200. I think we hit like 197 and change. So right now, I would expect that if we don't see a sell-off happen here in the short term, we'll probably go back up and close this gap up here around that 190 level. Then I would expect that we could see a little retracement in the live cattle side of the market. For feeder cattle, this is an April feeder cattle contract. Again, nice uptrending line. We saw a $60 drop when the market did drop. We see a few more gaps in this market that haven't been filled yet. We do have a couple that have gotten filled. But again, $60 down. We've seen the bottom come just around that 215. We're back up around that 253 area. We've had a nice recovery. We just closed the gap that came into play here in that end of October. Now I think we're going to shoot for this gap that's created right here, which would take us close to that 257 to 259 area, 257 probably. I think that we went up and we filled that. I think we would be looking at a little bit of a retracement. I would expect we could drop down to 240 and then see these markets come back up again. Now, short term, I am a little bit negative in the market because I do think just technically we need to see a little correction. Fundamentally, I am friendly to the market. I do think we'll see some push come back into the spring and see some strength come back in. I don't think we're going to go to new highs in the cattle market. I don't think the consumer is quite ready to do that. Not unless we start to see interest rates decrease and we start to see unemployment continue to be very low. But we have to be able to see interest rates decrease before I think the cattle can go to a new high. If that happens, then we've got a chance to be able to see a little bit more strength in it. But I do think the consumer will push back and go to alternative meats, especially pork and poultry, which are quite a bit cheaper than beef at this point. So, okay, I guess that's what I've got. Any questions?
Yep, if you have any questions, there's a chat screen on the right side. Does it look like we have any? I think we're good, Randy.
Okay, well, if there's any, guys can always email us or get a hold of us at the office tomorrow. We're easy to find.
Yep, and this will be posted on our app and our website tomorrow. So thanks for joining us tonight.
Thanks.